are in listen-only mode.
Hello, everyone. This is Mark Hendrickson, Executive Director of Florida Alpha. Susan Lay, my co-executive director, is also on the line along with today's panel. We welcome everyone to the first session of the 2020 Florida Alpha Educational Conference, gone virtual, with the theme of thriving through adversity. We thank everybody for joining. And before we get into the panel, we want to quickly go through some logistics, but let you know this, that many of the panels will be in this webinar format. So we hope everybody's learning how to follow the emails and get registered. Some will be in Zoom, and that'll be a little bit different, but I'm going to turn it over to Lisa with the Florida Housing Coalition. And I want to just really thank them because they've stepped in to do all of the back shop logistical work of putting this stuff together from a technical standpoint. So Lisa, I'll turn it over to you for some logistics.
Thank you, Mark. This is Lisa, your technical assistant for today's webinar. Wanted to let you know that all the participants are muted when you're entered. But I want to make sure that everyone can hear us okay. There is a little hand next to your name under attendees. If you could actually click on that, that raises your hand and lets me know that you can hear us. So if you could go ahead and click that. I see some coming through now. That's terrific. Thank you so much. Thank you, Amanda. Thank you, Cameron. Okay, great. Now, under the same dashboard, you're going to see a little box for questions. I want you to click on that. That's where you're going to type in any questions that you have for our moderator. And I am going to be prompting our moderator with those questions, so you may hear me towards the end of the webinar come back in. The webinar will be recorded and available at the Florida Alpha website. And that will be starting tomorrow. You'll be able to see this again. Now, if you have any audio issues, try to log off and then log back in. You can also just call in the audio call number you'll see on your screen, or you can email me during the conference. I will have my email up. I'm going to go ahead and turn it over to our moderator, Helen, and she is going to take it from here. Helen?
Actually, you're turning it back over to Mark because we're going to go through our sponsors.
Oh, that's right.
You can go. All right. Well, first of all, thank you to all of the sponsors. It's been really heartening to see everyone step up, and almost everyone stepping up at the same level that they had originally committed. It's been great, and that's allowed us to put this conference on for free, to have no registration fee whatsoever. So if you could go to the next slide, Lisa, thank you. There's our platinum, our host sponsors. I'm not going to read everybody after this, but I do want to do a shout out to these: Hillsborough County HFA, Jacksonville HFA, Raymond James, RBC, Broward County HFA, Panelists HFA, Escambia HFA, Lee County HFA, the HFA of Miami-Dade, and eHousing Plus. All of those are platinum or host level. If you could go to the next. There's our gold sponsors. Again, I don't want to cut into our time. This will all be, this entire PowerPoint will also be on the Florida Alpha website and available for you to download if you want to take a look at it. Thank you to the gold sponsors. If you could go on. Silver sponsors, thank you. Boy, the attorneys all land there. Maybe we ought, just kidding. And bronze, Florida Community Loan Fund, and our breakfast sponsor, though we can't have breakfast together, is First Housing, and I would note that for a breakfast sponsor actually falls between a gold and a silver. So with the thank you to the sponsors, I'm going to turn it over to the moderator, Helen Feinberg.
Thank you, Mark, and good afternoon, everyone. And thank you, Mark, Susan, and Lisa for all of your efforts on putting the webinar together. And thank you to our attendees for sharing your lunch hour with us. Our topic today is multifamily cutting edge topics. My role at RBC is managing director, and I'm manager of our Florida office as well as multifamily bond originations. And on the panel, we have 4 great panelists, including Ryan Hoover with Vescor, Barry Krinsky, director of Citi, Sean Jones, VP of Acquisitions, Raymond James, and Scott Macdonald with Blue Sky Communities. And we're going to take kind of a conversational approach with our panel today, asking each of them questions to comment on, spanning different multifamily topics here. And to start us off, we
Helen,
have
before you do that, real quickly,
Yeah.
just to Helen, this is Mark again, but just to remind everyone, if we go through the slides too quickly, no, they will all be posted on the website. So anything that's on a slide, you'll have access to be able to download by later this afternoon. Thanks.
Okay. And I think we were going to do questions at the end. So correct me if anyone thinks it would be better to go question by question, but just to make sure we get through the materials. All right, so we're going to kick off with Barry Krinsky. And Barry, COVID-19 has likely impacted the tax-exempt bond markets. Can you share any changes in underwriting, pricing, and availability of balance sheet in terms of GSEs and private bond purchasers?
Helen, thank you, and thank you for inviting me to be a part of the panel. I wanted to thank Ed Buzansky, if he's listening out there, for the virtual Cuban coffee that he provided me this morning, which is getting me in the right mood and pumped up to be talking here today. I am the National Head of Production for Citi Community Capital, and we focus on financing multifamily affordable housing. And since COVID-19 kind of raised its ugly head, on the 19th of March, we saw spreads. You'll see this is the 10-year treasuries. The good news is treasury rates are super low, and much of the types of activities that we finance are loosely correlated to the 10-year treasury or LIBOR swaps. And you can see from 2019, there's kind of been this steady decline in rates. There's a little bit of a spike in March, but that has come down significantly, and the Fed has kind of declared that they're not planning to raise rates for the foreseeable future. As somebody said, they're not even planning to talk about raising rates for the foreseeable future. If you could hit the next slide, what happened on I think March 19th, you'll see a spike where this is spreads on commercial mortgage-backed securities. Fannie Mae, Freddie Mac are kind of showing how their instruments price, and these are basically they provide credit enhancement to buyers of their paper, which basically guarantees timely payment of principal and interest to a buyer of their paper. And you can see before COVID-19 kind of came into full effect, spreads were pretty darn very compelling in the, call it 50 to 65 or so basis point range. When COVID-19 took full force in effect, there was a big spike, and all of a sudden there was a flight to safety, and investors didn't want to buy paper that supported multifamily projects. That had a ripple effect. This reflects taxable financings, but we had similar impacts in the tax-exempt marketplace. And Freddie Mac and Fannie Mae, for example, while their paper, in essence, investors wanted to get more of a return for buying their paper. Helen, I know you track very closely Fannie Mae's tax-exempt product, which is backed by a mortgage-backed security. What happened to that during the crisis? And then we can talk a little bit more as to how things have gotten incredibly better.
Sure, thanks, Barry. And there was incredible dislocation in the municipal market at the time of that spike referenced by Barry in mid-March, with rates just unprecedented, volatile swings in interest rates. And I think that the drop in CMBS spreads was in part, and Barry can speak more to this, the Treasury stepping in and providing quantitative easing for CMBS and lending money to folks to hold those kind of securities on their balance sheet. But the municipal market, while there have been some tools provided to assist that municipal market, there's nothing directly assisting, for example, what we call a Fannie Mae MTEB or MBS-backed tax-exempt bond. So like the Fannie Mae-backed municipal bond that's tax-exempt, in theory, should have a lower interest rate than a taxable conventional Fannie Mae MBS, which is essentially an identical security. You have a Fannie Mae MBS in either case. But yet, actually, the MTEBs have sold well in the marketplace, in the municipal marketplace, in comparison to other types of bonds, like university-backed bonds or GO bonds or water and sewer bonds, because of the government backing. But still, the spreads have come very wide to the fellow direct Fannie Mae MBS securities. They started out at close to 2% over the 10-year Treasury. I think one of the higher ones was 1.9, and they've been tracking down a little bit in the 160s and 170s, and most recently one in the 130s and 40s. So the pricing is getting better. The absolute rates, on the other hand, are still very good, ranging in the low to mid 2% range. So it's really more about the actual interest rates that are being earned by the investor than the spreads because of the flight to quality with treasuries. And then, Barry, I'll turn it back to you maybe to talk about the companion Fannie MBS or other GSE.
Yeah, Thanks, Helen. And that's kind of where we were going to get to what goodness is happening out there. The good news is, as the markets have calmed down, and these spreads have come down fairly significantly, the tax-exempt marketplace, as we kind of see it, they tend to be a few different main players out there. You have institutions, banks like ourselves, who will buy paper and put it on our books and just own it on a kind of a privately placed basis. And then you have Freddie Mac, who is a major player, who is also on the permanent, call it long-term, stabilized side of the market. Once a property has been built and stabilized, they will also provide long-term financing for these types of tax-exempt finance projects. And the good news is, as Helen said, the all-in rates are, I think at the lows of what I've seen in my career, you're looking at all in around a 320, and that includes all the costs of getting that financing, as far as what we would normally call a credit enhancement, call it fee, the cost that a Freddie Mac would put on there because they're guaranteeing that timely payment of principal and interest. That's if you had an immediate, even on a forward commitment. So providing this paper, once a property is stabilized, it's around, call it about a 3, right around a high, call it 3, 60-ish kind of range. So all in all, the pricing is really compelling with the treasuries really low. There is capital out there. Freddie is very active. We're still seeing a lot of banks active. We're active in the marketplace. We'll talk a little bit more as others get into the picture, a little bit more selectivity in the types of projects that we're looking at. Want to make sure we have strong sponsorship, want to make sure the locations are solid, the markets are solid from a standpoint of demand, which in Florida, fortunately, most of our markets, there's a real dearth of affordable rental housing. And so there's plenty of bond activity out there, and there are folks that are willing to lend on it.
That's great. Thank you, Barry. Why don't we move on to the tax credit equity market? Sean, COVID-19 has likely impacted those markets. Are there concerns that equity investors have less income and therefore a reduced appetite to purchase 4% tax credits? How have investors changed their underwriting and pricing for tax-exempt bond transactions?
Thanks, Helen. I appreciate that question. Definitely very valid right now. So just to back up a little bit and give everyone on the call a little bit of perspective, and then I'll jump into the question a little bit more and let everyone know how the market has, I guess, evolved is probably the nicest way to say it. But over the past year, I'd say from before March of this year, I was closing tax credit deals on equity for pricing in Florida in a range of approximately 92.5 cents for deals in smaller and maybe a medium county or so, where there wasn't much CRA need, to up to $1 for deals in more competitive southeastern counties. And each one of those deals that we closed, it was super competitive. Myself and other syndicators and directs were looking to secure deals and invest equity in most every deal that I ever bid on. There were at least 3 or 4 competitors going after deals. Some instances there weren't as many, but for most there was some competition. And then once March happened, I noticed significantly we started getting into discussions with investors and their concerns over how COVID-19 was impacting their balance sheet and their need to hold on to liquidity. And we quickly realized that there was a push to preserve liquidity as opposed to meet CRA obligations for banks, or for our other investors to meet their mission statement, which is invest in affordable housing transactions. So you had this sense of investors kind of hitting the pause button for a little bit and saying, look, we need to exactly get a real account of where we are, find out what our liquidity requirements are, figure out kind of what our investment goals are for the remainder of our exam periods, and then kind of move forward cautiously. And the pause seemed to occur amongst most investors that we deal with from, probably March till May. We are noticing, as Barry had mentioned, some things are getting a little bit better, and we are noticing some investors to kind of, I guess, proceed, I don't want to say cautiously, but start to invest like they were before COVID-19 hit. But there are folks out there who are still being cautious. Some folks have met their CRA obligations already and waiting for a new cycle to begin, and some folks are just kind of playing a wait-and-see game. So what investors are looking at the moment, the more vanilla a transaction you have, I think the better chance you have at finding investment on that deal. So it's funny, I've been working with a client in DC on this very complex sort of what they call a twinning deal, where they marry 4% credits up with 9% credits. They have a significant market rate component. They have a workforce component, retail, commercial, everything. super exciting deal, but it's so complex, they're having a very difficult time raising equity for that deal. So if just something in mind, just as folks are looking to kind of project timelines and stuff like that, I definitely recommend the more complex your deal is kind of getting out in front of investors as quickly as you can, or sooner rather than later, just to give them a little bit more time to kind of work with investors and find investment on those deals. However, what I've noticed most importantly is, whenever there's any sort of turmoil in the markets or anything like that, the most critical component is who your partners are. Relationships certainly matter these days. For deals that we're moving forward on with investors, the first question we get is, who is your partner? Have you worked with them before? If so, what's your experience? What are their deals looking like that have stabilized? What are their deals looking like that are under construction? How are they handling their COVID-19 requirements in order to make sure all the construction workers are safe? And whenever you're leasing up, how are they handling that process? So there's a lot more digging into the weeds, I guess, in terms of, how we're looking to investigate or underwrite these deals as we're moving through, just so we can make sure our investors are completely comfortable in moving forward, and so we can ensure that we get our developer partners the equity that they need. In terms of sort of underwriting standards or guarantees, the typical industry standards are still kind of holding firm on those, which is, an operating deficit guarantee sized at 6 months of operating expenses, debt service, replacement reserves, and then marrying that with an actual capitalized operating reserve for the very same equivalent. In Florida, we have been able to get a little bit more aggressive over the past in going down to a 3-month an operating reserve sized at roughly 3 months of operating expenses, debt service, and reserves. But we do get a lot more scrutiny from our investors in looking to figure out exactly how we're more comfortable with that, or basically in any way if we deviate from what industry standard underwriting guidelines are these days. And thankfully, whenever we're working with partners such as Vescor and Blue Sky, we're able to justify these lesser requirements just because of our track record with folks like that, and their ability to maintain performance on their portfolio is super helpful. And then that leads into sponsor requirements. We're absolutely taking deeper dives into kind of who our guarantors and our guarantor entities are. Sponsors absolutely matter. I mean, we'd always love to have a personal guarantee, but that's not always the preferred route to go. So we also we dig into the investments, make sure what the investments are used as financial backstop for our guarantees. And so our partners have been our developer partners have been very helpful in kind of helping explain some of them have more complex guarantor entities and investments, and we've found that our partners are very helpful in kind of working with us as we, I don't want to say apply this additional scrutiny, but I guess that's a pretty good phrasing for it. And then just in post-closing items, in looking at once a deal hits stabilization, once you're looking for your annual cash flow distributions or semi-annual cash flow distributions, we're looking to make sure that the properties are operating as well as we had hoped, or as well as we would like for them in this current climate. Thankfully, it seems like a number of our partners have not been impacted as negatively as we would have expected. It just goes to show how incredible our partners' management companies and their abilities to kind of get ahead of this thing and coordinate with their tenants or residents on how to best manage the payment of rents throughout this process. It's been incredibly helpful. And I guess I'd move on to, if I haven't worried you enough about like tax credit pricing or anything like this, just wanted to mention other things. The what else should I worry about slide is a little bit of a joke, but just wanted to give folks a heads up on CRA reform. That's something that is very critical in the tax credit industry because it's essentially a driver on what leads banks to invest in 4%, 4% and 9% tax credit deals. If I don't know if you all pay attention to the OCC web blast or sign up for that, but basically on May 20th of this year, the OCC adopted a final rule that changes the way that they are going to test for their Community Reinvestment Act requirements. Historically, there are three groups that govern banks or regulate banks on their ability to meet the Community Reinvestment Act requirements. You have the OCC, the FDIC, and the Federal Reserve. So I'm specifically talking about the OCC that adopted this rule on May 20th, which they used to have three tests, which was a lending test, a services test, and an investment test to see if a bank is meeting all of its CRA requirements, which is basically saying that if you're going to take deposits in an area, you need to provide services in this area, you need to lend in this area, you need to provide investments in this area. So they changed that to a single ratio test, which is a bit concerning because no longer you could basically a bank could not invest in an area, but say lend in the area as much as they were investing and potentially meet that goal. So it's yet to be seen how this will impact investment on tax credit deals, but it's something we're definitely keeping an eye on. Also keeping an eye on the 4% credit rate for bond deals. That is something that I know our developer partners would love to see. There is, especially given July's rate, which I think is 3.08%. So for folks on the call, just to give you kind of a heads up on how and why that's important, we just closed a 4% deal here in Florida at a tax credit rate of 3.08%. And so basically what you do is you take the amount of eligible basis under your construction costs, multiply it by that 3.08%, and that gives you a tax credit, your annual tax credit allocation. So just a quick analysis of the deal we just closed, which was a 110 unit deal. The equity changed by over $250,000 whenever we changed from the rate we closed on to a 4% credit rate. So, deals that might not be feasible now due to the low credit rate would become feasible. And so we're basically keeping an eye on that and hopeful that the 4% credit rate becomes a reality. I know it's in the Moving Forward Act, which has been advertised by the action emails and everything like that. I'm just not 100% sure if or when that might happen, but we're definitely keeping our eyes on that. And then the last thing, just wanted to mention the election. If I've learned anything from elections here lately, it's that they can create a lot of turmoil, and then they can sometimes not. So it's just something to keep on your radar, is how it might impact tax credits and everything else. But that's about it for me. Hope I didn't take too much of your time.
No, thank
Sean,
you.
this is Mark. I wanted to just real quickly, because there are people on the call that are highly experienced and some that are fairly new, could you explain just conceptually, when we say a 4% credit, how that really works? I mean, I think that it's not really 4%. Could you just briefly, describe how that's calculated really?
Sure. So whenever I talk about 4% tax credit deals, those are deals that are financed with tax-exempt bonds. So you apply for at the county level for bonds, and as a matter of right, you get tax credits, which they say they're 4% tax credits, but that rate is actually a floating rate as opposed to the 9% rate, which was locked a few years ago at 9%. So that 4% rate, which is currently 3.08%, dictates how many credits you'll get for the deal, which is significantly less than a 9% deal or a locked 4% deal. So you get those on a stream of credits for a 10-year period. And what we do is we essentially use a time value of money equation in our model and price those based upon paying you a price today for the future delivery of those credits. Is that kind of what you're looking for, Mark? Or I can.
Well, probably
No, that's
also
absolutely
that,
true.
yeah, I'm just
Okay.
saying that the AFR rate, like how it changes monthly, maybe the 4%, not really 4. I think you kind of already talked about that, but
Okay.
okay, very good. So moving along, Barry, what are the ramifications of forbearance granted to multifamily borrowers and renters by GSE or other lenders? What are you seeing? And Lisa, could you go back to slide 12 under Barry's items? I think he has some data points there.
I'm going to keep this really brief so that everybody can have an opportunity to hear from our other esteemed panelists. But the good news, relatively speaking, is that the agencies, Fannie and Freddie, came out with a program which basically allowed borrowers of their debt to they're able to provide them with forbearance, which basically means a borrower didn't have to make loan payments for up to 3 months, which the idea was to help get through this current time period of when collections may have been impacted as a result of people losing their jobs and not being able to pay their rents, etc. You do have to pay it back, and you have to pay it back within 12 months. So the result of it is, while it was offered to borrowers, the reality is very little forbearance has actually been processed. Here's an example of Fannie Mae's multifamily mortgage-backed securities that are outstanding. There's about 1.15% of all of their lending. It has forbearance that borrowers have entered into forbearance agreements. So what that basically says is that while there's clearly been some stress out there as a result of, in part, the enhanced unemployment benefits, there hasn't been as much problems at the property level from a borrower perspective. And frankly, borrowers have decided, in large part, even if they are seeing some short-term stress, they've been willing to continue to make their payments to keep their mortgages in check, and so that they're not going into default.
Very good. Thank you, Barry. So Ryan and Scott, which of your properties seem to be least impacted and most impacted in terms of COVID-19 and unemployment and underemployment? Ryan, can we hear from you first, and then we'll turn to Scott?
Yeah, thank you, Helen. Yeah, so we had our least impacted was definitely our senior affordable communities, just in the fact that, for the majority of the residents there, they're, retired on Social Security. So we've had really little impact as far as on the rent payment side. Obviously, we had to be very strict with the rules of who could go into the buildings because of the senior demographic. But they've been running around 0 to 1% bad debt at the end of the month, which is pretty much where they are in regular times. But on the family side, which we have, several properties in downtown Jacksonville, for example, where they're affordable workforce, some market, but the majority of the people that live in those are in the service industry, which the service industry was probably the hardest hit out of all of this. And so, at the height, maybe we had, 50 to 60 of 500 or so residents without work, but it's actually come down a good bit. So I think we only have about 17 people that are, still either have not gone back to work or are just working reduced hours. But all in all, we've come out a lot better than we thought we were going to in the very beginning. So we're pleased with that.
That is good. Scott, how about from your portfolio?
Yeah, thanks, Helen. I would echo a lot of what Ryan said is similar to what we've been seeing. Our elderly Section 8 developments have been minimally impacted at best. Obviously, like Ryan said, it's been much more stringent as far as visitor policies and maintaining safety and best practices based on what numerous agencies are putting out there. And then as you move along the spectrum to straight family tax credit developments that don't have subsidy, maybe some vouchers, then you start to see delinquencies tick up for all the reasons that Ryan mentioned. So while it has been trending slightly above normal, I would say, if you had asked me back in March, if we were still in a similar state as we were then, what June would look like, and in my opinion, it would have been a lot more dire than where we are. So I think it's been a pleasant surprise. I don't know how long it can keep up, but so far it's been going okay.
Thank you. And Scott, we understand that the HFA of Hillsborough has joined Metropolitan Ministries in Hillsborough County in establishing a rental assistance program for properties they have financed. Would you tell us the origin of this program and how it works? As I understand, one of your properties participated in this program. And so, Lisa, we're going to Scott's slides there.
Yeah, thanks. Going back to what I just said, I think that one of the reasons that bad debt and delinquencies look the way that they do is through programs like this. All the way from the federal down to the local level, agencies have stepped up to make sure that residents living in affordable housing are protected and supported during an incredibly difficult time. So what we've chosen to spotlight here is the Hillsborough County HFA and a program that they put into place in the middle of May to utilize some of their funds to target residents who live in properties financed by the HFA and have been greatly impacted due to the loss of employment or significantly reduced hours. So this program was approved at their May 15th board meeting and goes to help residents for up to 2 months at no more than $1,000 per month, and really try to supplement some of the other assistance that's been out there while focusing to make sure that the investments that they've made in affordable housing can continue to be viable and thrive during a difficult time. So they have been working directly with landlords to identify tenants and make sure that their funds are spread around their portfolio. So one statistic on here is that they were shooting to assist 150 families with this program. As of a couple of weeks ago, they had 108 residents in 20 different developments that had submitted for assistance. So, you have really a great story of a local HFA stepping up to utilize their own funds to put into affordable housing communities to assist their residents. What they were able to do is very quickly figure out the most efficient way to get those dollars out there and how to make an impact very quickly. So they partnered with a local 501c3 called Metropolitan Ministries, whose mission is to care for the homeless and those at risk of becoming homeless, to roll out these dollars very quickly. Next slide, please. So for those of you who are not familiar with Metropolitan Ministries, they're located here based in the Tampa Bay area, and they had a pre-established emergency rental assistance program, albeit it was at a much smaller scale. And here you see that last year they had just under 700 requests, totaling over $150,000. So in just under 3 months during the COVID crisis, they've already well surpassed those requests and the dollar amount many times over. So the Metropolitan Ministries has a funding source from local donations, from private foundations, and that kind of jump-started them during this time. Hillsborough HFA approached them about the $300,000 that they had approved to roll out, and were able to put that into the assistance program while being able to also meet the requirements that the Hillsborough HFA had put in place for how they wanted the dollars spent and who they wanted the dollars to go to. And I think, when you look at trying to juggle that during a difficult time for Metropolitan Ministries with all the other programs that they have and food assistance and the like, it's really a testament to what they've been able to do in this community, that they were able to juggle different requirements from different donors and still meet everybody's needs. So I think, it's just a really great story of how HFAs and local agencies can utilize their resources, but leverage them in a way that allows them to work with local organizations to get those dollars out as quickly as possible. So, Mark, was there anything that I might have missed? You're obviously intimately involved with this.
Well, yeah, that's a great job. And first, Scott, thank you to your company for, participating and reaching out to find your residents that needed assistance. That was critical, and thanks to all the other developers who did that. I think what it really shows, though, in the world of multifamily, is how quickly HFAs can act. Particularly, our county government in Hillsborough is a good one, and well run, and their housing department is got good people that we partner with and have a great relationship. But HFAs can just move faster. So while they're still working on what they're going to do with the CARES Act money, the HFA was able, from a mid-May decision to spend the money, had residents in process and checks going out within 30 days. I think that was the HFA lesson there. And also there was a question that came in while you were presenting, which was, does the program require the resident to repay the money? And the answer is absolutely not. This is, we're not going to debt burden people that have lost their job. That's not the point. The point is that the HFA has resources, doesn't have unlimited ones, but it has enough to cover, the rent for a couple of months with people that have lost their job because of COVID.
Yeah, that is great. It is a really unique program, and it was nice that the Hillsborough HFA had already established a relationship with Metropolitan Ministries, so they could really move very quickly. But this is a scalable and replicable program that others could use if they wanted to. And just Lisa, on the next slide on the CARES Act, I wanted to, just share this slide with folks that, the CARES Act, which was passed in March 30, Florida got $8.3 billion in funding, 55% allocated to the state of Florida, the remaining 45% to local governments. Initially, the amounts for local governments went to populations in excess of 500,000, and the remainder is being allocated to other local governments not otherwise receiving funding. And on the next slide, it just shows what the eligible expenses are or uses for CARES Act funds. And basically, it's there's broad discretion in terms of what the funds may be used for, but they must be deemed to be necessary and directly related to COVID. And I wanted to add that the Florida Housing Coalition has confirmed that rental assistance is expressly allowed. We don't know how many local governments are using their funds for rental assistance, but would certainly encourage them to do so if they deem it an appropriate use of funds and as needed. All right. So Ryan or Scott, are you guys aware of any other rental assistance programs? We may skip over this if, as I'm guessing the CARES Act would be the likely one, but anything else to highlight on this topic?
This is Ryan, Helen. Yeah, I mean, as far as anything else on a federal, state level, I'm not really sure. I know, individual cities like City of Jacksonville have their own stimulus programs, but I'm not aware of anything else other than what you've had listed.
Okay, well, why don't we turn to the development side for Ryan and Scott. How is the current pandemic impacting transactions that may be in your pipeline or future development activities? Ryan?
The majority of the ones that we already had in our pipeline were signed up, probably end of last year, very beginning of this year. So they were relatively unaffected by this. I mean, we did have one big bond 4% development that the investor backed out a week before closing, but we were able to secure a whole new financing team and get that signed back up, and we're closing on that one this week. And then, I think it's just going to depend on what happens over the next couple of months of how we're going to be affected with any new developments that we get, maybe later in this year.
Great, thanks. Scott, anything to note in your pipeline? Any challenges or opportunities?
Yeah, very similarly, deals that were sort of baked and had LOIs that had been executed. We've been, seeing things trek along with minimal impact. Some lenders are looking for additional, addendums to appraisals based on any COVID-19 impact. But really, the ones that got caught in the crosshairs were deals that were did not have executed LOIs. Ones that were slated to close later this year. We had one. We were kind of at the 5-yard line, if you will, on a couple of LOIs, one debt and one equity that had some challenges. But luckily we've established good partners and we're able to bring others to the table. So if there's a silver lining, of the whole thing, I think that shows you that the market has not come to a screeching halt like you've heard. It's gotten a little tougher, but there are still folks out there that are looking to make investments in solid deals.
Yeah, and I'm guessing that based on what Sean was saying, like there might be gaps because equity pricing might be lower than people had anticipated on their projects. So there might be some small financing gaps, but fingers crossed that maybe some COVID type relief package might fix our 4% tax credit, which would provide much needed, increase in the amount of equity, rather than like the 3.08%, which Sean described.
Yeah, absolutely.
Do our panelists have any other closing thoughts before we open it up for questions? Any points we want to make? Okay, well, Lisa, any questions from the audience?
This is Mark. There aren't any yet, so people, if you have questions, Lisa, if you could again show people where to type them in.
Yep, if you go to your dashboard, there should be a label that says questions. If you type in your questions there, we will make sure to get them answered.
And the dashboard is the big thing on the right side of the screen.
Helen, this is Barry Krinsky. Maybe while we're waiting for a question to pop up. So given some of the discussion on equity pricing and the ability to move deals forward, I think there's been some talk at Florida Housing relative to how to potentially fill some of those gaps. Is that right? Does anybody have any thoughts on that?
Well, that's a good answer from the panel there.
I know they're talking about it, but I mean,
hey, stump the chumps there, did you, Barry? Okay.
Man,
you get an extra prize for that.
Yeah. Hey, Barry.
You know what?
Scott.
That's a great. Oh, go ahead. Sorry.
No, I just was going to say, you know, there's been discussion, and I know that they're working hard on it. I don't know that there's been concrete enough details that it makes sense to delve into them, but I know they're working hard on it.
But that sounds like a great question for the next webinar, which I think is the Florida Housing team with Trey Price and with Marissa on.
That's 2 out, but next, you know, it's a great lead in, but there will be a webinar where we have the key staff people from Florida Housing. That'll be in 2 weeks. And that will be moderated by our board member, Florida ALHFA board member and Panelists HFA Executive Director, Catherine Driver, who will have Trey Price and Marissa Button and David Westcott on to cover everything in Florida Housing. And next week, we will have the state and federal legislative update at this same time and same bat channel next Tuesday. And by then the governor will have to have done something with the budget. So our wait to find out what will get vetoed and what won't will be over, and we will be able to give a complete recap of the legislative session and look forward to 2021, and also have someone on from NALFA to talk about federal issues at that time.
Great.
That sounds like
Anyone
a can't
else?
miss session.
Absolutely. Anyone else have any closing thoughts?
Yeah, no questions from the group, but a nice compliment. Good job, it says. So thank you to all our panelists.
Thank you.
Thank you for the opportunity.
Yeah, thanks to Florida ALHFA and thanks to Florida Housing Coalition. It was great working with both organizations on the webinar.
And Helen and Ryan, Sean, Barry, and Scott, Florida ALHFA really thanks you and Helen in particular for really organizing this. It is really appreciated, and the time of the panelists is also. So, you know, we're going to really crank it up and try to keep these panels going and give you a full conference, people that are out there and members of Florida ALHFA. We're just not going to do it in a day and a half time period. It will be spread out. If anyone has questions about future panels or issues regarding, you know, how to sign up, just email me at mark@thehendricksoncompany.com, and I'll try to work with you. And Lisa with Florida Housing to work with you. So, do note that almost all these do require that you register. And we had a few people this morning that were scrambling on that to try to get registered. And again, that's just how the system, and it's how we can track and know what's happening. So thanks again to the panel, and we will reconvene next Tuesday, June 30th at noon for state and federal legislative issues. And Lisa, that's a wrap.
Thank you, everyone.
Thank you.